Start investing in gold and silver at sdbullion.com today and join over 35,000 precious metals investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sdbullion.com today. Start saving on every precious metals purchase you make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Craig HEMKE from TFMetalsReport.com. Craig, thank you so much for joining us today.
Elijah, it's always a pleasure. Thanks for having me on again.
All right. Well, it seems like that there was a lot of talk about how the Fed wouldn't raise interest rates, but now the narrative is completely reversed, and the chances of a Fed rate hike this month are very high. I just saw the chances are estimated around 90%. So what is your perspective on a Fed rate hike, and how might it impact the precious metal markets? Because we were just talking before the interview, and you said it seems like the conventional wisdom is that it would harm the precious metal markets, but if you look back in recent history, that's actually not what's happened.
Yeah, let's take both sides of that question. One, yes, it was widely assumed that if anything, there'd be another rate hike this coming December. Maybe if the economy was really strong, there'd be two. But remind everybody that we've had two rate hikes in the last 10 years, and now all of a sudden people are talking about two within 3 months. And I'm not really sure what has changed economically. The U.S. GDP is still growing. It was less than 2% for all of 2016. At least the forecast so far for the first quarter of 2017, the one that we're in, are under 2% as well. We've seen an uptick in inflation, but even that's dubious data. That inflation data is put out by the Bureau of Labor Statistics. Those are the same folks that give us the employment numbers every month. And everybody knows how dubious that information is. So it almost seems as if the Fed suddenly has an agenda of hiking rates. Now, whether that's because Donald Trump's in office, whether they are just simply trying to give themselves some room to cut rates again in the future, as some people suggest, I have no idea. And the interest rate curve doesn't really suggest that a rate hike is imminent. The 2-year note, the 10-year note, the 30-year long bond are all about the exact same rate they were when the Fed hiked rates back in December. Even the LIBOR rate is about the same place that it was, the 3-month LIBOR. So all of a sudden we have these expectations that there's going to be a rate hike at the FOMC meeting in a couple of weeks. And we'll just have to see. Most of that speculation has come from just simple talk. We call it jawboning by these Fed governors that I like to call goons. They go out and they just talk, and everybody reports on it as if it's some kind of gospel, when really it's just speculation, and a lot of times it's empty speculation. We've seen that now for years. So we'll see what they do. Now, from a historical perspective, though, I think a lot of folks really don't even know this history. A lot of folks, like myself, came to gold, became gold bugs, gold and silver stackers, sometime after the onset of the great financial crisis. I didn't become Turd Ferguson until 2009, and didn't have a site until 2010. And a lot of folks are that way. They've followed the financial crisis. They know what a fraud everything is. They know about the banks being zombies and the Fed printing trillions and trillions of dollars, and all these central banks printing trillions of dollars, and dollar devaluation, and low to negative interest rates. And I think a lot of folks think that those are the only conditions under which gold and silver can rise, because we know that in 2010 and in 2011, as the Fed was printing like crazy with QE1 and QE2, and interest rates were plummeting and the dollar was going down, that was when we saw gold go from about $1,000 up to $1,900, and silver went from $20 an ounce up to $50 an ounce. And anyway, it's very easy to think, only looking at that last 6 or 7 year history, that those are the only conditions that make gold and silver go higher. But that's not true. If you go back further, gold actually bottomed. It spiked in the late 70s into 1980, as did silver, and really traded sideways for better part of 15, 19 years. The bottom in price is seen on the chart between about 2001 and 2003. We actually began 2003 at $300 an ounce for gold. But by the end of the first quarter of 2008, we were over $1,000 an ounce. That's a three times increase from 2003 to 2008. And if you go back and look, interest rates during that time period were pretty steady, in fact, actually rising for the 10-year note. So this notion that gold only goes up, silver only goes up while interest rates are going down just isn't true. It is not verified by history. With, like I said, from 2003 to 2008, prices tripled for gold, and interest rates were actually steady to rising. So if we are now in a regime, as I guess the common opinion is, of higher interest rates going forward, I just would suggest that maybe that's not necessarily bad for gold. And furthermore, Elijah, if you everybody knows their recent history. The first time the Fed hiked the Fed funds rate in December of 2015, gold bottomed the next day at about $1,050 an ounce. And over the next 6 months, in the first half of 2016, it climbed all the way to $1,380. Of course, it went down again up to this next rate hike that came in December of last year, but again bottomed the next day at $1,130 and was as high as $1,265 just a few days ago. I think the market senses that interest rates aren't necessarily bad for gold, but again, we've got to kind of figure that out. I mean, gold investors have to figure that out, that gold actually does go up during times of higher interest rates, and that may be why the price has risen off of the last two Fed rate hikes. And though we might be in continued tough sledding till we get this next FOMC behind us, we may very well see another up move after that FOMC rather than down. That's a long answer to, I guess, a two-part question, but that's kind of how I feel here today.
Now, I'd like to get your perspective on the move in gold and also especially in silver that we saw on Thursday. In gold, we saw gold fall more than $10 very quickly, and then for silver, it fell, it looks like about more than 60 cents. So what is your perspective on that move? Was that manipulation?
The gold, not so much. Gold is driven on most days by high-frequency trading. There are occasional interventions by cartel banks to sometimes even support price. They don't want it to go down because they don't want physical orders to be filled, and then these bullion banks are on the hook for delivering the physical. A lot of times gold is just going to be driven by computers, and a lot of those computers often take their cues from foreign exchange. And with all this talk of higher interest rates, the dollar's been getting stronger, the dollar-yen has been going up, and that has put pressure on gold. But in silver, the move on Thursday was clear to me, deliberate price manipulation, price rigging by the silver banks, the major shorts, J.P. Morgan chief among them, in that silver had been holding steady and really been trending higher. In fact, in the 5 days leading up to that rate on Thursday, silver was up every single day for a total of, I think, 47 cents. It was sailing along down just a couple of pennies until all of a sudden the bottom dropped out in classic cartel raid fashion on Thursday. At one point it was down 80 cents or so. Now, other metals, particularly industrial metals, were also down on Thursday. But the raid in silver, as sudden as it was, is what gets your attention. And then you look at what the target was. And the target was clearly to rig silver back down and below its 200-day moving average, which silver had finally, after it had been kind of resisted at that level for about 2 weeks, it finally burst through that level a week earlier. And then today, with the massive raid down, you got price back below that all-important 200-day moving average. The last time we saw a massive raid, similar to today, was for about $1.40, 3 days after the U.S. election. And not coincidentally, that also took out the 200-day moving average. These banks have issued naked short contracts and sold them to the speculators looking for long exposure, all the way off the bottom in December, growing massive naked short positions. Heck, Elijah, at one point just a couple of days ago, the total open interest of paper silver, virtual silver on the COMEX reached north of 1 billion ounces. I mean, the world only produces about 900 million ounces. So how is it that the COMEX could have open interest representing more than 1 billion, 1.1 billion ounces? That right there is fraud. That's just banks just simply taking the risk that they can outlast the shorts, and when they can't seem to outlast them, then they'll just smash price by dumping a whole bunch of new contracts at once. That's what we saw on Thursday. The intent is to rig price down to scare out even more of these long speculators so that the banks can cover even more of those shorts that they issued earlier this year. It's the game they have played for years, and again, they continue to play it to this day.
All right. Well, I'd like to get your perspective on the inflation that we might see in the future. Trump has talked about a $1 trillion infrastructure project. Do you see this kind of stimulus project causing a lot of inflation?
Well, the traditional economic analysis, the stuff that you're taught in college, the Keynesian theory that dominates nearly everything, that's what they say. They say, yeah, the government spends money. Those people then go out and build roads, and all of that money circulates, and the more debt you have, the more growth you have, and it put us in the position that we're in today. We'll see about the inflation. I mean, the inflation is there. Healthcare costs, tuition, rent, all that stuff is even food. I mean, what's a pound of ground beef cost versus a couple of years ago? That type of thing. The inflation's there. And it always has been. It's just a matter of whether the Bureau of Labor Statistics wants to measure it or not. And then the Fed seems to cherry pick whatever data they want to use to go out and promote whatever policy they'd like. You touch upon, though, I think a more important part of the picture, and that is the total debt. I wrote a few days back and posted to my site, and I would encourage everybody to look up the charts that I had to go to the internet and find off of Google. If you type gold versus U.S. debt level into Google and pull up Google Images, you'll find a whole bunch of charts from 5-6 years ago, because it was almost easy and predictable. You could plot the total level of U.S. debt with the gold price, and they rose together. In fact, by the time we got to 2012, they were both going up almost parabolically. Of course, we know what's happened to the gold price since, while the debt has continued to rise. And I would just suggest that, well, maybe, that relationship is going to reassert itself over the Trump years, especially if you do have some inflation. Debt's only going to continue to grow, and we may now very well see gold go to catch up with it. The debt, like you said, is a big part of Trump's spending and revival plans, and, nothing in his business history would suggest to you that he's afraid of debt, right? So we'll probably see the debt continue to rise. And again, as we discussed earlier, market history, if you go back before 2008, would suggest rising debt is a very positive. Rising U.S. debt is a big positive for the gold price, and that may be very likely where we're headed again.
All right, and the last topic I'd like to touch on today is about the stability of the European Union, if you wanted to comment on that, because I was just reading on Wednesday, it was reported on Zero Hedge, the Centix Euro Breakup Contagion Index was at a post-2012 record high at nearly 50%. This index is a market measure that estimates the probability of one or more countries in the European Union leaving in the next 12 months. Now, we've already seen Brexit, and the probability now of another country leaving is nearly 50%. So what is your perspective on the stability of the European Union going forward?
This is a really big deal, Elijah, and this is something that not many folks are really thinking about or planning into their forecasts. And it's going to wrong foot a few people, especially at the beginning, if all of this comes to pass. And by what I mean by this, a French exit from the EU, combined with Brexit, combined with what we call it to leave, if Italy somehow, catches a wave, and the Grexit, all that kind of stuff. This is a fundamental positive, probably the most positive fundamental for physical gold ownership. especially in Europe, than maybe we've ever seen. And what do I mean by that? Well, if the EU is going to break up, and that's a big risk to the euro currency, the second largest currency, is second most widely used currency in the world. Well, then that means that currency is probably going the way of the dodo bird, and we're going to be breaking back up into Deutschmarks and francs and lira and all that kind of stuff. Well, if you're a holder of euro, what are you going to do with them? Now, what you might see initially is a flight into dollars, right? And the computers, which control the gold price on a daily basis, are going to see the dollar going up, and they're probably going to sell gold because fundamentals, supply and demand, have really zero impact on the gold price on a day-to-day basis. What has an impact are these computers and how they trade the derivative contracts. So you might, on an initial surge of the dollar, see gold go down on a dissolution or a breakup of the euro. But on a real, grassroots level where the rubber meets the road, if you're a European individual, hedge fund, high net worth person, anybody, and you got euros, and your euros are going away, do you want to go buy Swiss francs, Deutschmarks, French francs? I suppose maybe to some regard, but why wouldn't you own gold? And with the rush into sovereign debt like German bunds, negative rates are only going to get worse. So why would you own paper currency in a negative interest rate environment? That's safe? Are you crazy? Why wouldn't you own gold? I mean, the argument always is gold doesn't pay a dividend, but versus a negative 1 or 2% interest rate, that no dividend looks pretty damn good. So the breakup of the euro, Frexit, even the Dutch and the Belgians are talking about it. The French, obviously, with Marine Le Pen. Italy's talking about it. If this were to happen, this would be an extremely strong, powerful fundamental for owning physical gold. Maybe even strong enough to ultimately break the stranglehold of the bullion banks on the gold market. We'll see. Either way, though, this is a big story for 2017 and something that people really need to be keeping track of.
All right. Well, Craig HEMKE, thank you so much for joining us today. Before we let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Well, we have a lot of fun every day, and I think we do a pretty good job at my site, tfmetalsreport.com. There's free stuff. There's subscriber stuff that's $12 a month. I would encourage everybody. I mean, now more than ever, it's a good time to be as much on your toes as possible as it regards to the metals and the global economy. We talk about it every day, tfmetalsreport.com. I encourage everybody to check it out.
All right. Once again, thank you so much for your time.
Elijah, it's always a pleasure.
Bullion.com today. Start saving on every precious metals purchase you make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today is Craig HEMKE from tfmetalsreport.com. Craig, thank you so much for joining us today.
Elijah, it's always a pleasure. Thanks for having me on again.
All right. Well, it seems like that there was a lot of talk about how the Fed wouldn't.
If anything, there'd be another rate hike this coming December. Maybe if the economy was really strong, there'd be two. But remind everybody that we've had 2 rate hikes in the last 10 years, and now all of a sudden people are talking about 2 within 3 months. And I'm not really sure what has changed economically. The U.S. GDP is still growing. It was less than 2% for all of 2016. At least the forecast so far for the first quarter of 2017, the one that we're in, are under 2%.
Start investing in gold and silver at sdbullion.com today and join over 35,000 precious metals investors who have made the switch to the lowest gold and silver prices in the industry. SD Bullion recently claimed a spot on the prestigious Inc. 500, making them one of the fastest growing bullion companies in the United States. With low bullion prices and over-the-top customer service, SD Bullion is setting the standard for precious metals transactions. Visit www.sd.
As well. we've seen an uptick in inflation, but even that's dubious data. That inflation data is put out by the Bureau of Labor Statistics. Those are the same folks who give us the employment numbers every month. And everybody knows how dubious that information is. So it almost seems as if the Fed suddenly has an agenda of hiking rates. Now, whether that's because Donald Trump's in office, whether they are just simply trying to give themselves some room to cut rates again in the future, as some people suggest, I have no idea. And the
raise interest rates, but now the narrative is completely reversed, and the chances of a Fed rate hike this month are very high. I just saw the chances are estimated around 90%. So what is your perspective on a Fed rate hike, and how might it impact the precious metal markets? Because we were just talking before the interview, and you said it seems like the conventional wisdom is that it would harm the precious metal markets, but if you look back in recent history, that's actually not what's happened.
Yeah, let's take both sides of that question. One, yes, it was widely assumed that